I'm honored to interview Sam Rines today in our next section, American Energy at a Crossroads. Samuel Rines is Managing Director at Corbu, which is a research intelligence advisory platform focused on the intersection of markets, policy, and national security. Sam is based out of Houston. He's talking to energy professionals on a regular basis. And he has a really unique perspective on energy markets. So I'm thrilled to be joined on stage with you today, Sam. Thanks for being here.
Okay. Thanks for having me, Stacey.
And I should also introduce myself. I'm Stacey Morris, Head of Energy Research at VettaFi. So to get started, Sam, I really want to start with the big picture. How are you thinking about the macro environment, inflation, interest rates, recession risk, and how does that help shape your view of the energy space?
Sure. So if 2022, from our perspective, was the story of Ukraine, was the story of fracturing of the energy markets, the story of inflation in the Federal Reserve, 2023 is pretty much the same, but with a little bit of a different cadence. There's a lot of, call it, optimism around the Chinese reopening. How is that going to impact the oil and energy markets broadly? How is rising India going to impact it? At the end of the day, what really matters is where we started. The initial conditions, which were entering the year, we had a fairly strong US dollar. We thought that the US economy was going to moderate. We simply haven't seen that yet. And we really suspected that we were going to have a rapid reopening of China, which did not materialize and is probably not going to materialize until the second quarter. And yet we still have $75 oil. That's really something that I think is underappreciated here, is that $75 oil without a true Chinese reopening and the fear of a US recession, that's something I don't think we really anticipated, call it 2 years ago, right? If you told me that China wasn't fully reopened and the US might go into a recession and you'd have $75 oil, I would have been very confused. So I would say, as we look at 2023, the cadence is really a fairly strong US economy, US consumer, through at least the first quarter, followed by a Chinese reopening that becomes real, continued rise of India, and probably pretty good and tight oil markets through the end of the year. So right now is probably the height of the quote-unquote downside pain for oil. And as we move into the back half, it becomes a much tighter, much more interesting market.
Yeah, I mean, I think you're absolutely right. You mentioned China reopening. There's so many kind of moving parts in oil markets, which is always the case. But as you think about this year, what are the major puts and takes that you see for oil?
The major put and take, when you look across all of the sentiment and all of the predictions for oil, is there's two main pieces. One, that China really isn't going to demand that much more incremental oil as they reopen, right? So by the end of the year, you're only looking at somewhere around 800,000 incremental barrels a day in demand. That's fairly optimistic. And the majority of the barrels being pumped out of the ground are going to come from the US. And that's, to me, where you really begin to have potential problems in the oil story. That the Permian in particular is somehow going to be up 1 million barrels a day by the end of the year is aggressive.
Yeah,
Yes.
no, I would agree with you. I think 1 million barrels per day out of the Permian is a tall bill to fit. What challenges do you see for US production growth?
Oh, the challenges for US production growth start, one, with what we all talk about all the time, which is inflation.
Yeah.
There's kind of taking a step back. We put about 30% CapEx in the oil patch in the US last year in 2022, which sounds like all of a sudden the oil patch is back. Wildcatting, you're going to pump a lot more oil. The problem is that price alone, just the cost increase, was somewhere between 20 and 25% on average for a well. That is an incredible amount of inflation. Service companies are booked out. It takes somewhere. There was asked, I think, in the second quarter by the Dallas Federal Reserve, how long would it take you to drill an extra well relative to your current plan? And the average response was 12 months. I mean, that is a very long lead time in order to be able to drill that incremental well. So it's not something where you're just saying, we're going to flip a switch really quickly. One, service companies are very tight. It's very expensive to drill that incremental well. And when your cost of pumping your current wells somewhere around $40, $45 a barrel, it's pretty tempting to just kind of take a step back and say, how much does it cost us to keep our production flat, not grow our production significantly? So this, kind of the 3 to 5% range on production seems like probably a pretty decent number, but probably towards the low end, not the high end.
No, I think you're absolutely right. I think we're going to see moderate production growth, but it's not going to be showstopper production growth that we saw maybe back in 2018 and 2019. Definitely a different environment in a lot of ways today. But how are you also thinking about Russia and their production volumes over time with sanctions kicking in, just recently product sanctions, and then just overall the view there?
So it was really a fracturing of the global energy markets. And the logistics around global energy are incredible. And you know this, and I'm going to pick your brain about it in a minute. But the logistics around global energy are spectacular. And when you really begin to dig into it, what Russia did was basically start sending their barrels towards India and China and doing it in a very meaningful way. To a certain degree, Malaysia as well for product refining. So it didn't necessarily take barrels off the market. It shifted where the barrels needed to go. And then the US began to ship a lot of LNG, a lot of our oil barrels, a lot of our diesel barrels to Europe to kind of replace, right? So we've been juggling around a lot of energy, but we really haven't seen Russia begin to come off market in a meaningful way yet. This is where I think we're a little optimistic on Russia. Going forward based on two things. One, sanctions go on really quickly. They come off very, very slowly, if ever. And there's a pretty important example of this, which is Venezuela is a very easy place to drill oil. It's just there. You just poke a hole in the ground, and the service intensity is rather minimal. And when we sanctioned Venezuela, Venezuelan production went off a cliff. Over time. Took about a year and a half to really begin to set in, and it's been pretty steady ever since. When it comes to Russia, US service companies were the dominant force there and had a significant presence. And we have had all of them begin to move back, Schlumberger, Halliburton, et cetera. When they begin to pull back, it is a sign that it is going to be troublesome going forward. Those, particularly Russian wells, tend to be a little bit more service intensive. They tend to take a lot more money downhole in order to be able to maintain the production, and they tend to have fairly fast decline curves. And those decline curves, without being able to re-drill those wells, we actually replace the production, that is going to begin to bite at some point. So I would say that you're probably looking at Russian barrels coming off market at a pretty significant pace relative to the current, rather optimistic. I think it's 1 million barrels this year. I would be closer to 2 million barrels by the end of the year on a run rate. And you're probably looking at 3 million in 2024 as a run rate for how quickly the services begin to bite on that front. So that's going to be problematic for global oil production.
Yeah, I mean, that suggests a much tighter market over time. On the topic of Russia, how are you thinking about OPEC Plus and the role that they're going to play in oil markets in the near term and maybe longer term? I mean, how does this eventually unwind, if at all?
I don't think OPEC Plus itself unwinds anytime soon, simply because they kind of have the benefit of having Russia there as a natural way to show that they're not being that bad, that they're balancing the market. I think that's going to be a really interesting story moving forward as you begin to have Saudi, Qatar, et cetera, begin to bring more barrels online to offset Russia and kind of have a steady state OPEC Plus. They get to act as though they're just steady. They're not taking barrels off the market, but in reality, it's a mix shift. It's a share gain for the Middle East from Russia over time. And it's interesting. Saudi Arabia has significant market share in both India and China. and has been losing that market share to Russia. And I think that's become somewhat problematic for the kingdom because those Russian barrels are kind of weighing on their ability to push price. That over time is going to begin to mitigate some of the problems. So I do think that you're going to have Saudi Arabia, Qatar, some of the Middle Eastern countries begin to pick up their barrels while Russia begins to lose them. But it's going to be hard to make up that 2 million, 3 million type number because you simply don't have that much spare capacity in the kingdom and the broader Arab Emirates.
Yeah, I mean, I think, that's a big issue that we've talked about for some time is just the overall underinvestment in production and at some point that kind of catching up. And I think for a long time, the thought process was that the US would fill that void with short cycle production, but you just mentioned 12 months to, drill a well. So.
And to your point, it used to be that the US, every single time that you had a spike in prices, you could rely on wildcatters in the US to just drill. It was, that there was a reason it was drill, baby, drill. It was the way they did it. And now we complained as investors for so long that we convinced the wildcatters to just stop. It's now a return of capital, a return on your investment, dividends, buybacks. That's really the mentality they're going with. And it's a completely different shale patch than you had before. It's not just the impact of costs, it's also what shareholders have told them they want, which is give us our money back, don't put a lot of money in the ground, don't burst the bubble. There's a long memory about what happened in 2014, particularly in Texas, and how long it took to recover from that. And just when everybody thought that they were beginning to recover and you had oil in the mid-70s, all of a sudden you had COVID and oil went negative. The oil executives remember that. The private oil companies remember that, and the service companies remember it distinctly. I mean, this is something they are terrified of going forward, is that if they do bring this production online, they're going to begin to incrementally bring down oil prices to the point where it no longer makes sense for them to reinvest outside of their business to exist into the future. And this is something interesting on your front, which is how does the midstream, because you do a ton on midstream, how does the midstream react to a US that doesn't pump as much as people think?
Yeah, I mean, I think a lot of times people think of midstream energy infrastructure companies as volume-driven businesses. So the assumption is usually that the more the U.S. produces, the better it is. But that's really not been borne out in equity performance over the last couple of years. We saw huge U.S. production growth in 2018 and 2019, but the equities really weren't working because prices were so low for the commodities and energy sentiment overall was very poor. So we actually think moderate production growth is great for this space. Doesn't pressure the commodity prices. It allows them some operating leverage, some growth opportunities, but they can really continue to focus on capital discipline, deliver that free cash flow, follow the broader kind of energy playbook of increasing dividends and buying back equity. And for the midstream space in particular, I mean, that's enhancing already very attractive yields. The underlying index for the Alerian MLP ETF, ticker AMLP, was yielding 7.4% as of Friday. So we think moderate production growth is a good thing, and it helps the free cash flow story and dividend story just get better and better for this space. But with that kind of segue, I want to talk a little bit more about energy investing. You've advised RIAs and asset managers over the years. Certainly we have many of those in the audience. What would you be telling them today about their energy allocation?
Yeah, it's interesting. I spent time working at a large RIA in Houston, 5 years as their chief economist and strategist. And one of the interesting things about being an RIA in Houston is that most of the clients that you run into happen to work in a specific field known as oil and gas, and you get to be very familiar, one, with how they think about the world, and two, how they think about diversification and working around it. One of the intriguing parts of the energy landscape at the moment is just how much of the energy transition is being really put into the equation. So it's not simply how are Exxon and Chevron doing, right? They make up a tremendous portion of the indices for oil and gas. It's much more how do we get exposure to lithium? How do we get exposure to copper? How do we begin to have some of these things in our portfolio to mitigate the impact potentially over time of my business, right? And particularly for the private energy individuals, they are very mindful that their business is probably not going to be something that's extraordinarily profitable in 20, 25 years unless they begin to really move forward. So how do I think about an energy allocation? It's much more of, yes, you're still going to have oil and gas and you need to have that in a portfolio, but it's much more thinking broadly about energy and which companies are really taking a much longer term view of the world and incorporating that into portfolios over time.
Okay, so it makes sense. It's not just go buy Exxon and Chevron because those are the names that people know. It's taking a broader approach, thinking about minerals that may be needed, those that are positioning.
Yeah, and to kind of hit this point home, BP announced earnings this morning, and one of the interesting parts about the way they're looking at the world is they're putting $55 to $65 billion into the energy transition by 2030. I mean, these are not tiny numbers. So they're using their oil and gas cash flow to diversify their business in a meaningful way to be able to not only survive, but to be profitable in an energy world that's a lot different from today. I mean, we've already had oil begin to fall as a percentage of the overall energy mix to something like 30-ish%. That picked up a little bit this winter thanks to Europe. But generally, you've already begun to see these companies really take it seriously, diversify their businesses while maintaining, their legacy hydrocarbon business and, continuing to pump. But the idea that you're going to have the significant reaction to $100 oil with more barrels put on the market from, the majors, even the kind of the mid-sized players, is just it's fantasy at this point.
Okay, no, that's really helpful context. And I think the European majors in particular have been really active on that front in terms of positioning, investing in renewables. And I think Exxon and Chevron are kind of getting there too.
Yeah, Chevron does have a significant biodiesel business. Yeah. And it's, that's been helped by California. But it's it's a decent, it's decent sized. It's by no means important to their bottom line, but it's a growing part of their business. So even they're paying attention.
Right, and I think that's something that we even see in the midstream space. Companies are starting to invest, they're starting to position, they're making partnerships in things like carbon capture and hydrogen, but it's not really impacting the bottom line yet. But more broadly, I want to talk a little more about the energy transition and evolving energy landscape, because I think that is something that is very important for investors. And I think there's probably a lot of misconceptions out there too. I think there's probably a cohort of investors who avoid the oil and gas space altogether because they are worried about these stocks eventually kind of going the way of the dinosaur. I think there's a pun in there, but what are your thoughts on that? Is that a mistake?
Well, yes. Yeah, I wouldn't say it's a mistake, right? Because part of it is a personal preference, right? And you invest in a way that you want to invest. One of the ways that I like to think of it is, Chevron, in a way, announcing a giant buyback and a significant dividend, is in a way giving, basically saying, you go do with our dollars what you want to do, and we're just going to pay you. And, if you want to invest in ESG, go for it. I think to a certain degree, it's somewhat of a mistake to overlook oil and gas, simply because the vast majority of these companies are not, they're investing for the future. They're not necessarily, call it, the best at expressing it, and some are a little, curt in the way that they talk about it. But I do think that there's an argument to be made that it is very ESG to invest in oil and gas companies that are transitioning over time, right? You want to at least be able to participate in that adventure going forward, where you do need hydrocarbons as we transition. It's not something like you can flip a switch and we're suddenly going to be, carbon neutral. We need to have those hydrocarbons to keep warm, keep cool, drive our cars, fly our planes as we transition moving forward. And if we didn't have hydrocarbons tomorrow, it would be a very bad world. So I do think there's an argument to be made that for companies that are doing the right thing moving forward, continuing to produce hydrocarbons while being mindful that the future is not a hydrocarbon world might be something that's worthwhile.
Yeah, so being conscious of the companies that are positioning for the future and focusing in on that.
Yeah.
And then more broadly, as you think about energy stocks in the energy transition, is there any other things that come to mind in terms of valuations or anything else that, investors should be thinking about from that perspective?
That the energy transition, energy stocks, et cetera, one, they're fairly cheap relative, or at least they were fairly cheap relative to their peers in the S&P. The European peers are very, very cheap. But there's also some interesting ways to think about production, which would be looking at the services companies. I think oil services companies are very well positioned here. The average length of a well in, of these lateral wells in the US has gone up significantly. So you're looking at about, I think it's 9,300 feet is the average lateral right now. Some are over 3 miles. You're talking some massive wells. Those are very, very service intensive. The services companies some of them are actually very ESG friendly. You have frac fleets that are electric now, which I think is just one of the most interesting things. You went from diesel horsepower to electric horsepower to frac a well in some cases. There's not many, but there's some. There's ways to not necessarily play directly in the production, but to play the cost increases that are coming through, to play the labor side, the labor shortages, et cetera.
Yeah, I think services has been an area that's done very well. It got hit really hard during the pandemic, but it has come back, and it's very compelling for people today to take a second look at. Energy now I think is around 5% of the S&P 500. It was down at 2%. What are your thoughts on that over time? I think people were probably underallocated to the energy space for a long time, and maybe still are. But do you see energy going back to 10% plus like it was once upon a time?
Energy maybe, but oil no. I just don't think you're going to have that type of 5 to 10 is a doubling of the weight. So I think that would be spectacular, unless you have a significant decline in tech or one of the other weightings that just kind of naturally adjusts it. It's going to be very difficult for oil and gas to get back to that 10% type number, mostly because I think you're going to see them become significant dividend plays, right? You're going to continue to see them giving back capital, not putting it in the ground, growing production, et cetera. So I don't necessarily think you're going to get that high, but I think it's a fairly attractive return when you're sitting at call it a 3 to 5, 6, 7% type dividend. That's a pretty nice bogey to be sitting at to start the year, and not necessarily have to worry about the fluctuations on the stock prices as much.
Yeah, I think that's an excellent point. One thing we've been trying to kind of point out is that the energy space is actually a pretty interesting income play these days.
Always.
The XLE yield's probably around 3%. And of course, if you get into individual names, you can find even more generous trends. I think BP increased their dividend 10% this morning. So for investors who maybe haven't looked at this space for a while, I think the point of maybe our main takeaway from our conversation is that there's a lot going on, a lot to be interested in, a lot has changed, a lot of tailwinds from a tight energy market and also, what these companies are doing in terms of free cash flow, buybacks, and dividends. So I think we're about out of time, but I wanted to thank you, Sam, for being here. Appreciate all your great insights. And thank you all for joining our session today. I appreciate it.